millions of people are being priced out of the market. So it's not as easy as just saying, oh, just go find a $250,000 house instead. No biggie. It's they don't exist, right? So we're at this problematic level of price points still being at all-time highs, but interest rates now going up to 2008 levels. So what is a buyer to do? They don't have an option. And really, if you are priced out, there aren't options. It does boil down to making more money, and it does boil down to waiting it out and hoping that the market crashes. All right, welcome back to the VIP Financial Ed channel. We're here to talk a little bit about what the heck is going on. We're going to continue to keep you guys plugged in. Obviously, we talked recently about the interest rate hikes that took place a handful of weeks ago. 75 basis points. Looks like interest rates are going to continue to go up. I think the best interest rates we're going to see all year are right now. We've got 40-year high inflation. We've got 3% interest rates jumping to 6% increases. And, again, we're talking about 18 million homeowners or households that are now potentially priced out of qualifying for a $400,000 mortgage. 30-year fixed rates are past 6% for the first time since November of 2008. So we are seeing territory that we haven't been familiar with in a decade and a half at this point. And I think there's many buyers that are starting to press pause on the buying process. It's starting to put some downward pressure on those sellers. It's a bit of a tug of war. Let's face it, none of us know exactly where things are going to go. And there are differing opinions out there. That is for certain. So let's talk real quickly about a payment breakdown. Let's say that a year ago, you were jumping into a 3% interest rate over 30 years on a $400,000 mortgage. Your payment would come in at around $1,686 of principal and interest each and every month. Whereas today, if you were to get in at 5.78%, just near that 5 7/8 interest rate over that same 30-year term on the same $400,000 mortgage, you'd be looking at an increased payment of $2,398, just shy of $2,400. Guess what, folks? The worst part about that is you're going to pay $463,000 in interest on that property compared to just $207,000 of interest on that property a year ago. That's over $250,000 in additional expense for the exact same property. And I guess what I'm wondering here is it too little too late to right the ship on this? Thoughts, Michael?
Yeah, I mean, we've done videos where, months ago, where we were talking about the Fed has to start raising interest rates. They did a 75-point basis hike recently. I still don't think that's enough. I'm hearing rumblings that within the next 30 days, we're going to see another potentially 75. So back-to-back 75 basis point hikes. Now, we understand why the Fed's doing it, obviously, to try and tame inflation, and it's going to ultimately do that. Haven't seen a huge drop in consumer, haven't seen a huge drop in corporate spending right now, but talking about home buyers, that's $700 a month coming out of their pocket for that increased payment on the same house. So what I think a lot of buyers are doing are, like I said, are they sitting on the sidelines? Or if they are going to continue to move forward with the buying process, they might drop to a lower price point. So they might have been in the market for a $400,000 house, at that 3%, which that's insane. That was in January. Here we are in July now, and it's at that, hovering at that 6% range, but dropping down to maybe a $250,000 house, which is going to have that effectively that same payment around that $1,700 on that 30-year AM that would have been a $400,000 house. So kind of that flexibility there is going to help people out.
Millions of people are being priced out of the market. So it's not as easy as just saying, oh, just go find a $250,000 house instead. No biggie. It's they don't exist, right? So we're at this problematic level of price points still being at all-time highs, but interest rates now going up to 2008 levels. So what is a buyer to do? They don't have an option. And really, if you are priced out, there aren't options. It does boil down to making more money, and it does boil down to waiting it out and hoping that the market crashes. But if you're now on the side of this isn't going to crash, and it does, you're screwed for the next 2, 3, 4, 5 years until the recovery. You can't get out. So you better have a long-term game plan. This better be dream home, at least 10 years. I'm not planning on moving. Or it's got the numbers have to make sense on the investment side, which AKA in most cases at these price points equals short-term rentals. And you better know you're in an area where they're allowed. For one thing, you got to make sure you're checking with your city and your county and make sure that these are is something you can actually short-term rent to begin with, because you certainly don't want to end up with a long-term rental by accident versus by design, or you're going to be negatively cash flowing that thing, and you're going to be riding through that same dip if the market does in fact crash, which I'm always of the belief that preparing for that and having that awareness of potential is so important, because it certainly doesn't hurt you if you do, but it will crush you if you don't. And, you know, I mean, we're speaking to two separate audiences, investor versus homeowner.
Well, I think you hit the nail on the head there. If you are a homeowner and let's say you have to move, you know, you get a job transfer, whatever the case may be, some scenario where now is the time for you to buy, whether it's a want or out of necessity, you know, that is kind of the crux of the entire argument that you have to kind of play on your head and do the math on it. I mean, does it make sense now? If I'm only going to live in this house for a 2 or 3 year window, then the answer would almost unequivocally be no. And that, of course, there's going to be circumstances that would vary. But if it is going to be a 10-year or maybe that forever home, then, you know, you can get in the home with the higher interest rate with the intention down the road, obviously, just to wait it out and then do a refinance. So two different schools of thought there. As an investor, I look at it and, you know, the interest rates are almost insignificant to me. Now, depending on what I'm going to do with the property, you know, if it were a flip, for example, then I do have to have, you know, kind of that end using buyer that's going to be the owner occupant at some point. So that interest rates do have to factor in on my exit strategy. If it's a long-term buy and hold, or you mentioned short-term rentals, for example, then, you know, my kind of buy rate is almost irrelevant.
Sure. I mean, you're just looking at the bottom line. We've got some great examples of that too, right? Where we've literally put on the books roughly $100,000 worth of new bookings on a short-term rental property that was projected to make $160,000 over the course of an entire year, and we did it in 2 months' time. So we still are seeing a tremendous amount of activity on that short-term rental side. You know, I'm generating a tremendous amount on one property in Colorado over the course of just this summer alone. So I certainly think as an investor, you have a little bit more ability to afford prices that are potentially at the top of a market. And even if there is a dip, it's justifiable. Of course, if the short-term rental market takes a hit as a result of people overpaying on gases, overpaying on gas prices, overpaying on groceries, overpaying on overall cost of living across the board because of the inflation side of things, it becomes a lot trickier then to expect that same number of potential guests to have the ability to afford going out and renting a nice property as well as frequently. And I think that's a realistic potential too, as I'm forecasting possible corrections. I can't with absolute certainty expect the same amount of earnings to happen next year on my short-term rental properties as I am this year. And if I don't realize them, then what? And I'm always just wanting to factor in the then what as a just in case.
Yeah, no, as an investor, I mean, you've got the ability to pivot. We had this conversation recently, you know, about the short-term rental market and what's going to happen, you know, were people going to lose expendable income? And it's been almost the exact opposite of that. In that case study that you gave right there, I mean, in 2 months, we hit 60% of the annual projected revenue on that house. I mean, that's real numbers. I mean, that's we haven't recognized it, but it's on the books and it's been deposits taken. And I mean, that's set up for success like that already. But so, you know, the hospitality, the entertainment industry, it's going to respond differently than just what the average homeowner housing market is going to look like. So what we love to do here on the channel is just continue to bring in new information. It's going to be applicable to different people for different reasons, you know, whether you're looking at it through, you know, potential homeowner lens or looking at it through the lens of an investor, which we happen to be both.
Great. Well, I appreciate you being on today, Michael. Look forward to having you back on the channel again soon. And we'll keep tracking this market for everybody here watching. Make sure you subscribe, drop a like on this video if you don't mind. It certainly helps us out a lot. And guys, until we see you on the next one, make it a great day and keep on cash flowing. Take care.